It's Sunday night. The question isn't whether you should buy gold and silver anymore. The question is whether you've already bought enough. Because right now, in December 2025, the rules of this market are being rewritten in real time. And most people won't figure out how much they actually needed until it's already gone. Let me show you why the math just changed. Disclaimer, this is not financial advice. I'm not telling you to buy or sell anything. What I'm showing you is the data, the mechanics, and the scenarios that the prepared investor is tracking right now. You make your own decisions. Here's what you're about to learn. First, why the traditional allocation advice from 2020 is now dangerously outdated. Second, the 3 hidden traps that make most people think they have enough when they actually don't. And third, the cold math framework that works whether prices spike or crash in 2026. By the end of this video, you'll know exactly how to calculate what's enough for your situation, not what some financial advisor copy-pasted from a textbook. What actually makes sense when the paper market and the physical market are moving in opposite directions. Let's start with the lie everyone believes. Hack 1, the paper illusion. Most investors think 5% to 10% of their portfolio in gold and silver is enough. That advice came from a world where paper and physical moved together, where you could always convert your position, where liquidity was guaranteed. That world is ending. Here's what I mean. Right now, reports suggest the COMEX has roughly 240,000 gold contracts open. Each contract represents 100 ounces. That's 24 million ounces on paper. But the registered inventory, the gold actually available for delivery, is sitting around 400,000 ounces, according to public filings. Do the math. That's a 60-to-1 ratio. 60 claims on paper for every 1 ounce of actual metal in the vault. Now let's talk about silver. Some analysts estimate the paper to physical ratio is even worse, potentially over 100-to-1 in the futures market. Here's the trap. When you own a gold or silver ETF, you own a share of a fund that might own metal. Most are unallocated. That means if 10% of shareholders decide they want delivery in the same week, the system breaks. It's not a conspiracy, it's just math. Now here's what they didn't expect. In 2023 and 2024, Eastern central banks and sovereign wealth funds started treating gold like a strategic reserve again. China, India, Turkey, Poland. Reports show they've been adding hundreds of tons per quarter. Not as an investment, as a geopolitical insurance policy. When central banks buy, they demand physical delivery. They don't take paper. So every ton that moves east is 1 less ton available for Western paper claims to settle against. Remember this, the paper market sets the price, but the physical market decides who actually gets the metal. And right now, those two markets are splitting apart. But the paper chart is not the real battlefield. AC Act 2, the physical reality. Let me show you what's happening on the ground. Go to any major bullion dealer's website right now. Public filings and dealer reports suggest that inventory turnover times have doubled since 2023. Products that used to ship in 3 days are now listed as 2 to 4 weeks. Some 1-ounce gold bars from smaller refineries show limited availability or pre-order only. This isn't a demand spike, this is a replacement crisis. Here's how it works. When a dealer sells you a coin, they immediately try to replace it from their supplier. The supplier orders from a refinery. The refinery needs to source raw material, either from a mine or from recycled scrap. But here's the problem. Refineries hedge their exposure. If the spot price drops suddenly, they might delay purchasing new raw material because their hedge position makes them wait for better pricing. If the price spikes, they scramble to cover short hedges and prioritize contracts with industrial buyers, solar, defense, electronics, who have must-fill orders. Retail? You're at the back of the line. Now let's talk about premiums. In a normal market, premiums over spot are 3% to 5% for silver rounds and to 2% to 4% for gold coins. Right now, some analysts report premiums of 8% to 12% on silver products and 4% to 6% on gold, depending on the product and dealer. That premium is the market's way of saying paper price is fake. This is what it actually costs to get metal into your hands. And here's the kicker. If you own unallocated gold or silver, whether it's in a bank vault program, certain ETFs, or a pooled account, you own a claim, not metal, not a serial number, a claim. If the institution you're dealing with has 10,000 clients and 8,000 ounces in the vault, 9 out of 10 of you are in a game of musical chairs. Reports of delayed redemptions and administrative processing times started appearing in 2024 from certain European vault programs. Not failures, just delays, which means someone got their metal and someone else is still waiting. Counterparty risk isn't theoretical anymore, it's a timer. So when people ask, how much is enough? The real question is, enough of what? Paper claims or physical metal with no one between you and the asset? Because in a liquidity crisis, paper gets you a lawsuit. Physical gets you optionality. Now here's where it turns into a global chess move. Act 3, the global flow. This isn't just about supply and demand anymore. This is about geography. Here's what's happening. The Shanghai Gold Exchange has been trading at a premium to London and New York for months. Reports suggest the premium has ranged from $20 to $40 per ounce at different points in 2024. That's not supposed to happen. In a normal market, arbitrage traders would immediately ship metal from New York to Shanghai, collect the premium, and close the gap. But it's not closing. Why? Because Eastern buyers are paying the premium to secure physical delivery. They're not trading. They're accumulating. Now let's talk about silver's industrial bid. Silver isn't just a monetary metal anymore. Every solar panel uses silver paste for conductivity. Every EV has roughly twice the silver content of a normal car. Defense contractors use silver in electronics, missiles, and radar systems. These buyers don't care about the spot price. They care about securing supply. When a solar manufacturer in China needs 500,000 ounces for Q1 production, they don't wait for a dip. They buy because they must. And they're not buying from COMEX. They're buying from refineries with locked contracts, which means the metal flowing into industrial use is gone. It doesn't come back into the investment market. It gets turned into products, used, and eventually ends up in a landfill or a recycling chain that takes years. Here's the setup for 2026. The West is still treating gold and silver like trading vehicles. The East is treating them like strategic necessities. Industry is treating silver like a supply chain crisis waiting to happen. And retail investors are still being told 5% to 10% is fine. Now watch what happens when those three forces collide. If Eastern demand stays strong, if industrial orders keep rising, if even 2% of Western paper holders decide they want physical delivery in the same quarter, you get a liquidity event, not a price crash, a supply shock, where the price on your screen says one thing, but the price to actually get metal says something completely different. Remember, price discovery happens at the margin, and the margin is shrinking. Monday, next open battle plan. So here's what to watch as we move into 2026. Signal 1, premiums. If premiums stay elevated or rise further, that's your proof that physical supply is tight. If premiums collapse back to 2% to 3%, it means either demand cooled or supply freed up. Watch this weekly. Signal 2, delivery delays. Check dealer listings for shipping times. If in stock becomes pre-order or 2 to 4 weeks, that's your early warning. The smart money doesn't wait for the news article. They watch the product availability. Signal 3, Shanghai premium. If the Shanghai premium widens past $50 per ounce, it means Eastern buyers are in panic buy mode. If it closes or goes negative, it could mean Chinese domestic supply improved or demand cooled. This is your global flow meter. Signal 4, COMEX registered inventory. Public data shows registered gold inventory has been volatile. If it drops below 300,000 ounces and open interest stays high, you're looking at a potential delivery squeeze. This is the canary in the coal mine. Now let's talk about the two scenarios for 2026. Scenario 1, the melt-up gold breaks $2,800, then $3,000. Silver catches momentum and runs toward $40, then $50. Premiums explode to 15% to 20% as retail FOMO kicks in. Delivery times stretch to 6 to 8 weeks. Eastern buyers accelerate purchases. In this scenario, if you don't already own physical metal, you're either paying nosebleed premiums or you're stuck in a queue. Paper profits look great on screen, but try to convert them. That's when you find out the exit door is crowded. Scenario 2, the rug pull reset. Central banks pause, rate cuts, or even hike again. Dollar surges. Gold and silver get crushed on paper. Gold back to $2,200, silver to 24s. Weak hands, panic sell. Media declares gold is dead again. But here's the twist. Physical premiums stay elevated or even rise during the sell-off. Why? Because strong hands are buying the dip in size. And because industrial buyers don't care about the paper price, they need the metal. In this scenario, the paper market and physical market fully decouple. Your ETF shares drop 20%, but the cost to buy a 100-ounce bar only drops 8%. That spread is the truth. So here's the framework. The framework. How much is actually enough? Forget percentages. Think in ounces and optionality. Here's the cold math. Tier 1. The emergency base, 3 to 6 months of expenses. This is your system fails for 90 days insurance. Calculate your monthly essential expenses. Food, utilities, fuel, basic needs. Multiply by 3 to 6. Now convert that into ounces of silver at today's premium adjusted price, not spot. Example. If your monthly essentials are $3,000, your 6-month base is $18,000 at $32 per ounce silver, including premium. That's roughly 560 ounces. This isn't an investment. This is operational liquidity in a form that doesn't require a functional banking system. Tier 2, the wealth preservation layer, 10% to 20% of investable assets. This is where gold shines. Take your total investable assets, not your home, not your retirement account, you can't touch, but liquid net worth. Allocate 10% to 20% into physical gold. This layer protects purchasing power if your currency loses credibility or if we see a sovereign debt crisis. Gold has been money for 5,000 years. It'll still be money in 2026. Tier 3, the asymmetric opportunity, silver for upside convexity. Silver is the high beta play. If you believe industrial demand plus monetary demand plus supply constraints, Taller's price explosion, then silver gives you leverage to that thesis. But don't overweight it to the point where volatility wrecks your psychology. Most prepared investors keep 25% to 40% of their total metal stack in silver, the rest in gold. Tier 4, the what if insurance, platinum, palladium, numismatics. This is optional. Platinum is deeply undervalued relative to gold if you believe hydrogen economy or emission control demand rebounds. Platinum is a pure industrial play. Numismatic coins offer collectability premium but come with liquidity risk. Most people don't need Tier 4. But if you're deep into metals, it's worth understanding. Now here's the part no one talks about, storage and access. If your metal is in a vault 500 miles away with a 72-hour redemption process, it's not really your metal in a crisis. If it's under your bed and your house burns down, that's not a plan either. The pros diversify storage, some at home for immediate access, some in a private vault for security, some in allocated segregated storage with a reputable provider for scale. Never put it all in one place, never put it all in one form, mix coins, bars, and sizes, and never assume your unallocated account will deliver in a squeeze. Here's the bottom line. The amount of gold and silver that's enough for 2026 is the amount that lets you sleep at night while the financial system plays musical chairs with paper claims. It's the amount that gives you optionality when premiums spike and delivery times stretch. It's the amount that keeps you out of the panic buy queue when everyone else finally figures out what you already know. The paper market is a casino. The physical market is the battlefield. And right now, the house is starting to run low on chips. You don't need to predict the exact moment the music stops. You just need to have a chair before the song ends. So ask yourself, if premiums double in 2026, if delivery times stretch to 8 weeks, if your unallocated account says processing delay, how much do you wish you had bought today? That number, that's your answer. If this video helped you think differently about 2026, hit the subscribe button. Drop a comment and tell me, what's your biggest concern about the metals market going into next year? And if you want to see the deep dive on COMEX delivery mechanics or the Shanghai arbitrage play, let me know. I'll make it next. The prepared investor doesn't wait for certainty. They position before the crowd arrives.